A company can build something genuinely excellent, watch it become indispensable to hundreds of millions of people, and still lose 90 cents of every dollar its investors put in. That is not a story about failure. It is a story about what happens when a market decides a product is a platform, and the product turns out to be something smaller. This is the story of Zoom. The engineer who kept asking the wrong questions. For years, Eric Yuan held a senior engineering role at Cisco, responsible for WebEx, the enterprise video conferencing product Cisco had acquired for $3.2 billion in 2007. Yuan spent that time doing something unusual for a vice president. He kept talking directly to customers. What he heard was consistent and damaging. Calls dropped without warning. Audio lagged in ways that made conversation feel artificial. Joining a meeting routinely required downloading plugins that nobody wanted and everyone resented. Yuan brought those complaints to Cisco's leadership. He was told the company had no interest in a major product overhaul. In 2011, he left. He took roughly 40 engineers with him and founded a new company built around a single premise: video communication that actually worked, especially on mobile devices. The first public version of Zoom launched in January 2013. Within that first month, 400,000 people had used it. By May, the number had crossed 1 million. By 2016, the company was reporting revenue growth approaching 300%. Sequoia Capital invested $100 million in 2017, valuing the company at $1 billion. At that point, more than 40 million people had used the platform, including 9 out of 10 of the top American universities. Zoom completed its NASDAQ IPO in 2019. It was profitable. It was growing. It was, by every meaningful measure, a well-run enterprise communications business operating in a specific, defensible niche. Then the world changed in a way no business plan had anticipated. 300 million users in 4 months. Between December 2019 and April 2020, daily meeting participants on Zoom increased 30-fold. Not 30%, 30 times. The user base moved from 10 million to 300 million in roughly 16 weeks. In a single quarter, revenue climbed 355% to $663.5 million, easily surpassing analyst projections of $500.5 million. Net income jumped from $5.5 million to nearly $186 million in 1 year. The number of enterprise customers generating more than $100,000 in annual revenue more than doubled to 988. On August 31, 2020, shares closed at $325.10, a record. The company that had been a profitable niche tool 2 years earlier was now briefly valued at close to $160 billion. If this trajectory looks familiar, it should. Markets have a recurring habit of treating exceptional circumstances as permanent conditions. They did it with railroad stocks in the 1870s. They did it with internet companies in 1999. And in 2020, they did it with any company that happened to be essential during the lockdowns. The question was never whether Zoom had built something real. It had. The question was whether the conditions that made it irreplaceable would last. If you are watching this and thinking about companies that became institutions overnight and then had to figure out what they actually were, this channel covers exactly that. The subscribe button is below. Use it. The first cracks. The financial picture was already more complicated than the revenue numbers suggested. Gross profit margins had dropped from roughly 80% to 71%, as hundreds of millions of free users consumed real infrastructure costs without generating a dollar of revenue. Zoom was paying for every one of those calls across its own data centers and through agreements with cloud providers, including Amazon and Oracle. CFO Kelly Steckelberg acknowledged cancellation rates running above the company's historical average. Then, the credibility problems began. In November 2020, the Federal Trade Commission reached a proposed settlement with Zoom over privacy practices, finding that the company had made misleading claims about end-to-end encryption. The service was not, in fact, end-to-end encrypted in the way users had been led to believe. Zoom was required to overhaul its information security program and faced potential fines of $43,280 for each future violation. FTC Commissioner Rohit Chopra dissented sharply, noting the settlement contained no financial compensation for affected users and no meaningful accountability. 1 month later, the problem became geopolitical. Federal prosecutors charged a former China-based Zoom executive, Xinjiang Jin, with disrupting video meetings organized to commemorate the 31st anniversary of the Tiananmen Square crackdown, allegedly at the direction of Chinese government authorities. Jin was described as Zoom's primary liaison with Chinese law enforcement and intelligence. Prosecutors alleged he had directly terminated at least 4 such meetings in May and June of 2020, including gatherings that included survivors of the 1989 student protests. His accomplices allegedly fabricated accounts in dissidents' names, framing them as supporters of terrorism and political violence. Zoom confirmed it was cooperating with federal subpoenas and an SEC inquiry into its relationship with China's government. The company fired Jin and placed other employees on administrative leave. For a company whose entire value proposition rested on trust, on the promise that a private meeting stayed private, the accumulation of these events was corrosive. And they arrived precisely as the conditions driving Zoom's growth were beginning to dissolve. At this point, I want to ask you directly. When you first heard about these issues in 2020, did it change how you used the platform? Write your answer below. I read every comment. The acquisition that could have changed everything. Zoom's leadership understood the problem clearly. A video conferencing company that had scaled on pandemic demand was now facing a return to something resembling normal life, and its core market was going to contract. The company needed to become something larger than what it was. In July 2021, Zoom announced a $14.7 billion all-stock agreement to acquire Five9, a cloud-based contact center operator with more than 2,000 enterprise clients. The contact center market was valued at roughly $24 billion. The acquisition was Zoom's single largest strategic move, a direct attempt to embed itself into enterprise operations in a way that went beyond scheduled video calls. It never closed. On September 30th, 2021, Five9's shareholders voted the deal down. Proxy advisory firms ISS and Glass Lewis had both recommended against it, warning that the all-stock structure exposed Five9 investors to a company whose growth had been built on conditions that no longer existed. A Department of Justice-led committee had been reviewing the transaction over national security concerns tied to Zoom's Chinese operational history. And because the offer was structured entirely in Zoom shares, it collapsed for the precise reason Zoom had needed it. The share price had already fallen substantially. The currency Zoom intended to use for expansion had lost too much of its value to be acceptable to the people it was trying to buy. The decline was feeding on itself. What comes after the peak? The numbers that followed told a story of controlled contraction rather than catastrophe, but the trajectory was unmistakable. By May 2022, revenue growth had fallen to 12%, the slowest rate since the IPO. Shares had dropped 85% from the 2020 peak. Operating expenses had risen 56% as the company spent heavily to defend a customer base it was already losing ground on. Adjusted operating margins shrank from 39.1% to 34.6%. By November 2022, the total decline from the October 2020 peak approached 90%. 6 brokerages cut their price targets in a single month. The company that had briefly been worth $160 billion had shed roughly $140 billion in market capitalization. In February 2023, Zoom eliminated approximately 1,300 positions, about 15% of its entire workforce. The company projected charges of up to $68 million related to the restructuring. Eric Yuan announced a 98% personal pay cut and surrendered his bonus. The executive leadership team accepted 20% salary reductions. The company that had hired at scale during the pandemic was now contracting in a market that had moved on without it. Then came the moment that clarified everything. In a leaked internal meeting in 2023, Yuan told employees that certain staff would be required to return to the office. The CEO of the company that had done more than any other to normalize remote work was now stating in plain terms that his own product was not sufficient for the kind of work his company needed to do. There was no other way to read it. The name change and the question that remains. In November 2024, Zoom formally removed video from its corporate identity, transitioning from Zoom Video Communications, Inc. to Zoom Communications, Inc. The company has since moved into AI-integrated productivity tools, positioning itself as a platform for working faster and more effectively, language that deliberately sidesteps the question of where that work happens. Whether the pivot holds is a genuinely open question. The AI investment cycle moving through major technology companies in 2025 and 2026, with capital expenditure estimates running into the hundreds of billions across the sector, creates both an opportunity and a pressure. Zoom must now compete for relevance in a landscape where Microsoft, Google, and Cisco are all deploying similar capabilities at larger scale. The Zoom story does not resolve cleanly. What it demonstrates is the difference between a product that becomes essential and a product that becomes structural. Video conferencing became essential in 2020. It turned out not to be structural, not a platform on which an entire enterprise ecosystem could be built, but a feature that larger platforms could absorb and offer as a component. Zoom spent several years and roughly $140 billion in market value learning that distinction. The software was never the problem. The problem was the story that got built around it, and how long it took for that story to meet the reality of the underlying business. Whether this company finds a different story in the years ahead is the question that the next chapter will have to answer. The situation is not resolved. Subscribe, and the next chapter will find you.